Tax evasion and tax avoidance are two terms used to describe different behaviors related to taxes. While both involve minimizing tax liability, they differ significantly in terms of legality and ethical considerations. Tax evasion. Definition. Tax evasion refers to the illegal act of deliberately underreporting income, inflating deductions, or engaging in other deceptive practices to evade paying taxes owed to the government. Key characteristics. Illegal activity. Tax evasion is a criminal offense. It involves deliberately violating tax laws with the intent to deceive tax authorities and unlawfully reduce tax liability. Deceptive practices. Individuals or businesses engaged in tax evasion may use fraudulent means, such as hiding income, creating fictitious transactions, or maintaining secret offshore accounts to conceal assets. Intentional noncompliance. Tax evasion is characterized by intentional and willful noncompliance with tax laws. It involves an active effort to deceive tax authorities and avoid paying taxes. Penalties and consequences. Penalties for tax evasion can be severe and may include fines, imprisonment, or both. The severity of the penalties varies based on the amount of taxes evaded and the nature of the fraudulent activities. Tax avoidance. Definition. Tax avoidance is a legal practice of arranging one's financial affairs in a way that minimizes tax liability within the boundaries of existing tax laws. It involves using legitimate strategies to reduce taxes owed. Key characteristics. Legal compliance. Tax avoidance is within the legal framework of tax laws. Individuals and businesses engaging in tax avoidance are adhering to the letter of the law while strategically managing their financial affairs to optimize tax outcomes. Use of legal loopholes. Tax avoidance often involves taking advantage of legal loopholes, incentives, and deductions provided by tax laws to minimize tax liability. These strategies are considered acceptable within the legal system. Strategic planning. Tax avoidance is typically a result of strategic financial planning. It may involve decisions related to investments, business structures, deductions, and other financial choices made to legally reduce tax obligations. Ethical considerations. While tax avoidance is legal, ethical considerations may arise. Some may view aggressive tax avoidance as exploiting gaps in the tax code to reduce tax liability, even if it is within the bounds of the law. Key differences. Legality. Tax evasion is illegal, involving intentional deception and violation of tax laws. Tax avoidance, on the other hand, is legal and involves strategic financial planning within the confines of existing tax laws. Intent. Tax evasion is characterized by intentional noncompliance with the law, involving deceit and fraudulent practices. Tax avoidance involves strategic planning to legally minimize tax liability without engaging in illegal activities. Consequences. Tax evasion can lead to criminal charges, fines, and imprisonment. Tax avoidance, when done legally, does not result in legal consequences. However, aggressive tax avoidance may attract public scrutiny and potential changes in tax regulations. Ethical considerations. Tax evasion is universally condemned as illegal and unethical. Tax avoidance, while legal, may be subject to ethical scrutiny if perceived as exploiting loopholes or engaging in overly aggressive practices. Examples. Tax evasion examples include hiding income, creating fake transactions, and using offshore accounts to conceal assets. Tax avoidance examples include utilizing tax credits, deductions, and legal structures to minimize tax liability. In summary, tax evasion involves illegal and intentional efforts to evade taxes, while tax avoidance involves legal strategies to minimize tax liability within the bounds of the law. While tax avoidance is generally considered legal, ethical considerations may arise, especially in cases of aggressive tax planning that push the boundaries of acceptable practices.